also for those of you who are not able to join in person today, we thank you for logging on afterwards. So today we have Matt Briefer from Traction Accounting Group to talk about New Year accounting best practices. And this is something that's really coming front and center for me as I'm looking at 2024, 2025 planning, and hopefully setting up a clean process for moving forward. I think at least for startups and nonprofits, I think it can be sometimes the last thing you really want to think about, but it's awfully important as we know. So I will leave it to Matt from here, and thank you so much for offering this presentation.
Yeah, absolutely. Happy to help. Thank you, Laura. Um, just want to confirm everyone can see the presentation here. Can all see the
Yep.
screen? Perfect. So yeah, today we're going to talk about New Year accounting best practices. The hope for today is I'll share some missteps we've seen others make in the past, so you don't have to make them yourself, and we'll learn some tips and tricks, and that'll help everyone have better accounting and better businesses in 2025 and beyond. So to dive in here, a little bit about me. My name is Matt Briefer. I'm originally from Tucson, Arizona, and I came out to Denver in 2016. All the photos on the right are all the things I love. So got my wife Alyssa in here and our two senior citizen fur babies, Mickey and Gracie. We love to go out and hike and camp with them, and they're still kicking even though they're getting old. And then cycling and snowboarding. Professionally, I started my career out in Washington, D.C., where I got my master's of accounting and CPA. I worked at PwC and led finance at a startup. When I moved out to Denver in 2016, I started Traction Accounting Group. We do outsourced accounting for growing mission-oriented businesses. So we really love clean tech, and I'm excited to today, when I put this presentation together, I really tried to think about what are some issues you guys see in this space specifically. So hopefully we'll hit on a lot of really relevant points. Generally speaking, we serve seed and Series A businesses, as well as more established companies between $1 million and $10 million in revenue. Our focus is outsourced accounting. So we don't do audits and we don't do tax. So spoiler alert, probably not going to spend a lot of time talking about tax today, but if you have specific tax questions, feel free to shoot me an email. My info's on the last slide here, and I'll make sure to get you connected with a colleague who can get you support there. In terms of what we do focus on, within that outsourced accounting, we come into our clients and we want to understand their business, their goals, their challenges. From there, we can build the accounting around operations. So what that looks like is if numbers are messy, we can get them cleaned up. We set up processes, and then we're positioned to do the accounting each month for the entrepreneurs that we work with. So accounts receivable, accounts payable, books, financial statements, and a whole bunch more. But essentially, we're serving as your outsourced accounting department. So with that said, I'd love to learn a little bit more from you guys. If you can share in the chat, maybe what is one word that describes how you feel about accounting?
I like outsource. That's a good one.
Yeah, afraid, outsource, scary. Ugh. Yep. No, these are awesome. I'm not surprised by these answers at all. That's kind of what I was expecting. So those are all very reasonable, and I understand why. And I think the goal today is we'll make it a little bit less negative and hopefully positive, but at the very least, maybe we'll reach some neutral territory with it and we can make it less scary. So thank you for sharing. All right, so why are we having this presentation now and not in August? Simply put, the new year marks a fresh start for financial records. So this is a great time to catch up your accounting if you fell behind. This is surprisingly common. For example, I met with a business owner let's see, we were talking in December about coming in to help them with their accounting this year. And when I was going through things to put together a proposal, I saw the books hadn't been updated since February of 2024. So like well behind. You don't want to let that linger into 2025. We want to get them caught up. Close out lingering issues. Really good examples here could be like accounts receivable and accounts payable. So it's not uncommon. Maybe in March of 2024, you sent a customer an invoice and they didn't pay you. Maybe you followed up a bit this summer and it kind of ran out of gas. It's a small dollar value, but you haven't collected it. Like now it's the end of the year. Let's either actually get that cash in the bank or let's write it off our books and clear it out so it doesn't hang out forever. We also want to make sure that the books are accurate. We always want them to be accurate, but especially this time of year before you send them off to your tax preparer. So a really simple way to eyeball your books and know if they're right or not would be to open up QuickBooks and look at your balance sheet. And you can see you should be able to see your bank accounts there, and you can see the dollar balances at December 31st. Open up your bank statement as of December 31st. Are the two numbers the same or are they different? Uh, if they're the same, that doesn't mean your books are entirely accurate, but you should be in the right ballpark. If the numbers are different, that's a really quick way to know you've definitely got issues creeping up somewhere during the year that you'd want to uncover before you just carry that into 2025. This is also a great time to make changes to your accounting. So a really common example we see is businesses that sell annual services and collect cash up front. Maybe in 2024, we sold a $1,200 annual service and we took $1,200 of revenue in August when we sold it. In 2025, maybe we want to record it as $100 a month, evenly as we're delivering it. You can do that anytime, but it makes a lot of sense to make big changes like that, kind of in line with the new calendar year. And lastly, this is also a good time to do structural changes. So a good example here might be payroll. Maybe last year you were viewing payroll all in one bucket, just total wages. Maybe this year we want to see how much our research and development team costs us, how much our administrative team costs us, our sales team. So we want to start using departments. There's like structural things that need to happen there in your payroll system and in your books to easily have those numbers. This is a great time of year to work all that into your systems. So there's a whole bunch more, but I hope this gives you guys a good flavor why we're talking about this now and why doing all this stuff in January can make a lot of sense. So now we'll kind of really dive into the meat. What are some of the issues we see and what are solutions? And I guess as we kick this off, does anyone want to share in the chat like any personal experiences with a painful accounting issue you've faced in your business? Yeah, bookkeeper really messing things up. Yep. Wrong accounts, new accounts, duplicate accounts. I like that one. Any others? Got open invoices. Okay, great. Well, that gives us some good stuff to hit on. I think bookkeeper really messing thing up. I actually think probably all three of these we're going to end up talking about as we walk through. So if there's any others, feel free to drop them in. Or if we get to the end and I didn't hit on anything you're wondering about, feel free to ask about it. As we keep working, as we keep going here too, definitely, you don't have to wait till the end to ask questions. I think we're a pretty tight group. So as things come up, I encourage you to drop them in the chat and just ask, and I'll stop periodically throughout. So let's keep rolling. So, what's a common accounting issue? That your books are wrong. Uh, when this happens, I feel like this woman here pulling her hair out, and like you can see, mine's already all gone. So, um, it's definitely a real thing. Why are the books wrong? Um, Oftentimes we have the wrong person doing the books. So maybe you had a bookkeeper and they were a great fit, but your business changed a lot over the last year. The complexity just might have outgrown them. Another common example is you might have your tax CPA doing your books. They're a CPA, they know what they're doing, but if their specialty is taxes, they're probably doing hundreds of tax returns, and the books are a means to an end, so they can do the tax return. They're not usually that person's sole focus. So tax preparers don't always make the best kind of day-to-day financial accountants. Another really common issue we see is maybe you opened a bank account or a credit card during the year, but didn't link it to QuickBooks. I have an example. In 2017, we had a startup client. The CEO opened up a new credit card and put $75,000 on it over the course of the year. We didn't know about it. He didn't tell us. He didn't connect it to QuickBooks. A year later, he stepped out of the business and another CEO came in, at which point this surfaced. And it was a pretty big deal. We were missing $75,000 of expenses throughout the year. So those weren't included in the books, and we also owed that money. So it can be really easy. Hey, maybe you get a promotion and sign up for something. Definitely make sure in real time that's linking back to your accounting software. And since that experience, now we ask every client every month, did you open any new bank accounts or credit cards? So definitely a good thing to be on top of. Transaction coding fell behind. We spoke to this a little bit before, but best practices definitely, do your books every month. Not only are you not going to fall behind so you have real-time info, but it's also going to be easier for you to remember what things were. It's pretty hard to look back if you sit down once or twice a year to get things caught up. Odds of getting the transactions to the right place and with the right level of detail go down a lot. Misapplied or unapplied transactions. Good examples here, like an unapplied transaction. I think this was in the chat that we never properly close out with invoices. So to speak to that, if you maybe you create an invoice in December and send it to a customer, and then they pay you in January, if you don't correctly apply the January payment to December, now you've recorded revenue again in January, so you've double counted your revenue, and your books still show that this customer owes you money. So we definitely want to make sure we are properly applying transactions in QuickBooks. Misapplication would be maybe you have a customer and they have 3 invoices open for 3 months of goods or services. They're all the same dollar amount, and they send you a check for one. You want to make sure you're applying that to the month they intended to pay you for. If you're just guessing and just marking off a random invoice, usually that comes back to catch up with you at some point down the road. And then lastly, your business changed, but your accounting didn't. I think, right, a lot of people don't really want to deal with accounting. It's scary. I think one of the responses in the chat was, like, I just don't want to do it. So it's pretty easy to like just assume your accounting's good and set it and forget it. But as your business changes, your accounting needs to evolve with it. If you're doing the same thing in year 3 or 4 that you were doing in year 1, you're probably overlooking a lot. So, and anytime something big happens in your business, it probably needs to flow through. So what are some solutions for all of this? Let's engage the right people. When you add a new account, connect it. Stay on top of your books every month. If you are using invoice or bill functionality in QuickBooks to track what your customers owe you or what you owe your vendors, and you're doing it yourself, pop on YouTube and just watch a quick 10-minute video on like how that functionality actually works. So you understand what you should be doing as you're going through trying to properly apply things. When your customers pay you, if they're not clear what invoice they're paying, just follow up and ask them. It's much easier to know now, hey, I got this money in and it's for the March services than guess. Because a year from now, you'll follow up with them telling them they owe you money on something and they'll tell you they paid that one. So you definitely want to be aligned with your customers, what it is they're paying you for. And then just proactively communicate with your accountant. It's really easy to pick up the phone. Hey, I'm thinking of doing X. Are there any implications here? And then at least you'll understand. So I know there was a lot there. Yeah, do we have any questions on anything I just hit on before we keep cooking?
I did have one, but I'll hold it till the end.
Actually, Matt, I got one if you don't mind.
Sure.
How do you like? We're in the process of hiring a new bookkeeper. So, like, how do you know if they're good or not? I guess, or how do you know if they are screwing things up before it's too late?
Yeah, that's a great question. I definitely get a referral. I guess, odds are they're going to refer you to someone they did a good job for, but it can't hurt to get a referral. Beyond that, if maybe you have maybe you really trust your tax CPA, maybe you could ask that person to just hop on the phone with the person you're considering for 20 minutes and ask a few questions and kind of poke around. I would definitely think about too, like, have they worked with companies like yours? There's a lot of people who have been doing books for a really long time. Like if you post a job online, you're going to get hundreds of applicants of people who have been doing books for 20 years. That's all well and good, but have they done books in your industry, especially if you have grants or you are going to go to raise money from institutional investors? Think about how much complexity is in your business and ask specific questions around if they've dealt with that in the past. And then obviously like formal accounting education, experience as an auditor in a prior life would go a really long way. I'd look for, I ideally just formal accounting training, formal accounting work, as opposed to maybe someone who's just self-taught and been doing it a while. So is that
Awesome.
helpful?
Yeah, definitely. Thank you very much. Appreciate it.
Yeah, great question. Cool. Let's keep rolling. So next issue, we see a lot, cash flow issues. This is relevant for pretty much every business. So why do we struggle with cash flow? Number one reason is if you're not closing your books monthly, it's pretty darn hard to know where you stand, how much cash you have, and then how quickly you're going through it. You're going to be flying blind, and you won't know if you're like this plane about to go into the water. So we got to keep on top of it. Not reading your financial statements, this can be a couple reasons. The first might be you're really busy. And maybe your accountant sends them every month, but you're a technical founder and you want to work on your product. And like we all established, no one is super excited about accounting, so it's pretty easy to ignore them. So we definitely want to read our financials. Maybe you don't understand them. So that's the other piece. You might be getting them, but maybe accounting's not your background, so you're not sure how to read them. If that's the case, reach out for a meeting with your accountant once a month to have them walk you through. Like they can shine a lot of light. Timing issues are another really common one. We see this often with grants, which I know a lot of you probably have, especially if it's like a reimbursable grant where you have to spend the money first in order to get funded. So that can create cash issues for businesses. And then lastly here, maybe you're not keeping a cash forecast or the one you have isn't accurate. If you're not doing those things, it's probably pretty hard to know how much runway you have in your business. So some solutions, again, let's do the books every month. That is a best practice. Meet with your accountant periodically to go through the financials together. With regards to timing issues, I have a few ideas. The first is take advantage of vendor terms. So if your vendor has net 30 terms, like don't pay them the day you get the invoice. That cash is better in your account than theirs. And ideally, if you can swing it, don't pay your vendors until you get paid from your customers. For many of our professional services clients, this is baseline. They make sure that they collect from their customers before they pay all their subcontractors, and then they're doing it with the money they've earned from the work and not their own money. Raise additional capital for cushion. So like I know oftentimes the goal is as much non-dilutive capital as possible, but especially if it's, if it is that reimbursable grant setup, you need to make sure you're going to be able to have enough cash to spend the money first. So definitely do your homework up front and make sure you're asking for enough. Maybe you do need a little bit of dilutive capital to get you by. Maybe you personally have to put a bit more in the business, but it's worth thinking about. And I always like to apply the rule of two. Everything costs twice as much and takes twice as long as you think. So if your plan says it's going to be $1 million in a year, it's probably going to cost $2 million and take you 2 years. So think about that up front when you're going to raise money. It can go a really long way to alleviating major cash pressures when you're trying to execute on your plan. If possible, open a line of credit with your bank. That might be hard to do as a startup, but Silicon Valley Bank and Bridge Bank, kind of the venture banks might consider doing that. If your business is making money, you should be able to do this with pretty much any traditional bank. And then lastly, have a cash forecast. So I'll show you what a couple examples look like now. This would be an example of a short-term cash flow forecast. So I know there's a lot of numbers on the page, but it's pretty simple what's happening here. This is the first half of November each day. And we have our beginning cash balance. And then this is dollars in we expect from our customers. And to get this data, because you've been keeping your books every month, you can maybe pull the past 6 months of data and see on average how much comes in each day. Is there a certain week where more comes in? So that can help you set these numbers. And I've just seen in the chat here.
Yeah, I was just wondering, are you sharing your screen right now? Because I couldn't see anything.
I am sharing my screen.
Okay, I do not see it, so maybe that's me.
I can
Catherine,
see it.
you can? Okay, weird. All right, carry on.
Can other people see it? All right, Mary sees it. Yep.
Yeah.
All right, so screen's up. So yeah, let's use our historical data to see when during the week, when during the month we're going to get our dollars in, and then what are the big expenses we have going out during the month. So in this example, we've got payroll, we've got our credit card payment, we've got some contractors to pay, we have a recruiter. Let's just map it out by day. So what we're seeing here is for most of the month, there's no cash problem at all. But when we run payroll on November 15th, it's not going to clear. So that's a really bad look for your employees. And so that's why it's good to be ahead of it. If you had this, you'd be at least 2 weeks ahead of that fire drill, if not more. So for businesses that are in a cash burn position or like nearing the end of their runway, this is a really helpful view. And if this was my client, I'd probably advise them, payroll should always be the first priority. So I'd question if we could hold off on paying our offshore team, maybe this recruiter and these contractors, so we can make sure payroll gets through. And then maybe, if we extend this out further, we'd see there's enough cash that comes in just a few days later to let some of these other things go. So that's a nice example of how you can monitor cash flow short term. Looking longer term, this is a basic budget. So I think even if accounting and numbers aren't your main jam, I bet any one of you could prepare this in 1 or 2 hours. Essentially, you would export your financial statements from QuickBooks for the past 12 months. So this is all of your historical data, and then put it into Excel and add 12 more columns for the new year, and just go down row by row and look at your historical data to inform what assumptions you want to make about the new year. Like at the most basic way would be to just take averages. If there's seasonality, maybe you'd see that and you could layer that in, but just start with your baseline. And then once you've done that, think about what's going to change this year. So in this example, in the budget period, we've got revenues increasing because we're expecting some growth. Maybe with payroll, if you're thinking about hiring, maybe you add one additional tab to this Excel workbook, list out every employee in your company, what their monthly salary is, and then link the sum here. And then in there, you can go toggle what it looks like if you hire someone, or give someone a raise. You can see how that flows through. And at the end of the day, that's going to get you your net income. And it's the same math, right? Beginning cash plus or minus net income equals ending cash. That's not perfect, but if you're doing that math like directionally, this is going to give you a good view of where you should be tracking with cash over a longer period. So in this business, they've got 425,000 in profit for the year. No major cash issues here. There's money to invest. Life is good. If this was a startup client with a burn rate, we might see cash running out in August, and we could know that today because we've mapped all this out. And if this was our client and cash was going to run out in August, I'd probably advise we create something like this starting in March or April so we can start keeping really close track of things as we near the end of our runway. So again, there's a lot there in that cash flow section, so I want to pause again. Does anyone have any questions?
Do you advocate for budgeting contingencies into cash flow, or how would like in terms of operating contingencies or stuff like that, or how would you think about the unknown for this
Yeah.
forecast?
Always start with your baseline, and then I think a really good budget is conservative. So I would probably I probably overstate my expenses by a little bit. I'd leave some cushion. Again, like just think back to that rule of two. It's probably going to cost you a little bit more than you think. And then I'd pull the other way on revenue too. Maybe I'm not going to, quite, what happens if I hit 80% of what I think? So I think a good budget is conservative, but it also has kind of a stretch goal for revenue. Like you don't want to totally sandbag your revenue just for the sake of being conservative and contingency planning. Like you should strive to grow, but you can always have a second version. So another good best practice would be do this with your best assumptions and then do a save as, and then, cut your revenue in half and see where the dollars fall out. Or layer in a bunch more cost. And then you've got two versions. One is what you're aiming for, but the other kind of shows you your worst case and helps you get comfortable with that.
So you wouldn't add like an express like operating contingency line item. You would just kind of bake in some, assumptions within the line items themselves or whatever you currently have.
You could go either way. I mean, both are going to get you to the same output. So I think whatever is easiest for you and you're most comfortable with. If I was doing it, I'd probably layer it in certain places, but that's a little bit more detailed. But I like this stuff, and I'm an accountant. So if you guys are doing it and just trying to keep it simple, I think adding a contingency row is totally fine. It's going to get you the same output.
Cool. Thanks.
Yeah, thank you. Any other questions? Righty. Moving on. Another big issue we see, lack of standardization. This is really common, especially with startups. So why is that? You're early on. You're still refining your offering. You're still figuring out how your operations work. There's a whole bunch that's happening in the first few years of business. So it makes sense that it's not all uniform. Things change, and that's normal. Another reason we see lack of standardization is nothing's written down. I don't know that I've ever come into a startup that has processes documented like a mature business would. But again, like if you haven't done that, the odds that things are not standard are probably pretty high. And the odds that there's alignment across your team on how things get done, it's probably unlikely. You could have one workflow, but three different people might have three slightly different takes on how it's supposed to work. So this can create a lot of accounting issues. So when this happens, every transaction becomes unique. So every transaction takes longer to work through, right? We want accurate books because with accurate books, it allows us to do like the cash forecasting stuff we just looked at. It helps us raise money. It helps us with grant compliance. But if everything's different, we got to ask about everything. And you can get different answers from different people. A really good example we saw relatively recently was we had a client with a long-term contract, and we were trying to figure out how far along they were to inform how much revenue we should show in the books. And the CEO gave us one answer, and the project manager gave us another answer. A process could be the unlock for having that conflicting information, right? What is the process by which we determine how far along we are in delivering on our service? Is it hours worked? Is it costs incurred? Is it milestones met? Right? There's a bunch of different ways to look at it. And unless we all align on what the one way is, you stand to get different answers from different people, which can have a big impact on the books. Going a little bit further, if you haven't put the time in up front in your business to get some repeatable processes, it's really hard to leverage automation as you get bigger. If everything goes well, eventually you're going to start growing faster. There's going to be more transactions, more employees, more customers, more vendors. Volume goes up on everything, but everything's different. So we can't automate it, or it's a really big lift to get it there. And ultimately, like all of this just kind of builds upon itself, and you end up with really complex books, a lot of inconsistency, and things might not be accurate if we're making assumptions. And you put all this together, and then eventually when you need to be audited, it's really hard to pass. You've got to organize like Charlie Day up here with his flow chart on the whiteboard. If you had to audit that would be really challenging versus, a neat stack of papers organized on a desk. So solutions, document processes in your business. There's actually a great book called Traction. It's not associated with us, but I highly recommend everyone read it. It's a great operating platform for you to run your business on. But within Traction, there's a chapter on process documentation, and they put forward a really simple way to do it. Like this doesn't have to be some massive undertaking. You could document each key area of your business in just a couple pages. And even that would go a long way towards creating alignment. Don't over-engineer, keep things simple, less is more. We see this a lot with customer contracts, right? If you're going out to get your first three or first five customers, you're really eager to close the deals. It's very common to like just start customizing entirely to meet whatever the buyer wants in terms of even just how you price it, how they pay you, variable payments. We've even seen like non-cash be a form of payment. Like now we're getting paid in equity. There's some really weird stuff out there when you're kind of desperate to close a deal. And I'm not saying don't do it. Like sometimes that is best to do, but I think just having an awareness that if you're doing that, it's going to build upon itself and just ultimately create a lot of complexity in your business. So ideally, if you approach things from the mind of like, if the deal's worth doing, I'm going to be able to do it in a simple way. It's a good place to start, and then compromise from there. We often see commissions get really complex as well. Maybe you want to hire great team members, but you don't really have the money to do it. You can end up with some really weird compensation schemes, and those two areas, commissions and revenue, have pretty big impacts on accounting. So just even if you're going to be complex, go do it. We have tons of clients who do nuanced things, but it's really nice when they give us a call, because sometimes we can say, this sounds complicated. I get why you're doing it. Go ahead and do it. But if you tweak this sentence in the contract, it's going to make it a lot easier for us to handle on the back end and save you a lot of money long run and be simpler. So just proactively communicate. Let me hit grant reporting issues, because I know this came up in the chat, and then we'll pause after this and kind of catch up on any questions. So this is another big area we see issues with, especially with clean tech. A lot of times when I have an intro call with potential clients and I ask, what's your biggest pain point? The answer is, I can't report on my grants. I'm having trouble. I'm having trouble. Sorry, I was reading the chat and got distracted. I'm having trouble doing my grant reporting and meeting my compliance requirements. So often when we see that, it comes down to a structural setup issue. Similarly, when you get a grant, it's not always just coding expenses one-to-one to a grant. There's some things that need to be allocated, which can be difficult to do. Another common issue we see is like being able to provide support and receipts for things. So in terms of solutions, there's a bunch you can do there. The first really comes down to the structure in your QuickBooks account. And so this kind of hits on the first two issues. If you've got a grant, you definitely want to take a look at what you're doing in QuickBooks. And the first piece would be getting your chart of accounts correct. And so your chart of accounts would really be everything that runs vertically down here. And you can see this is a really nice example. Everything is numbered. We've got kind of parent-child relations going on. So the three main buckets in our business are sales and marketing, R&D, and then general and administrative. And within each of those, I've got various levels of detail on what my expenses are. So we definitely advise, be really thoughtful about what you want to see in your reporting, both from a managerial perspective and a grant perspective. What's going to help you run your business? That's good to think about up front, and then you can build your chart of accounts in a way that like captures data on the front end to give you the info you want on your back end. So start here, read your grant requirements to figure out what level of detail you're going to need to share. And then ultimately, in most cases, you'll track grants using classes in QuickBooks. That essentially adds another dimension of detail you can tag to each transaction. So in this example, think of each class as a grant. So here we might have grant 1, grant 2, grant 3. And now I can run a report for each expense account. I can see exactly what grant the charge related to. This will make reporting at the end of the period easier, more simple. So that's kind of the basics of it. And then in terms of allocations, right, some costs will code one-to-one. We paid X vendor for this thing, and it clearly relates to this project. Other stuff like payroll, for example, you might have your team working on all three of these grants. So even though you have QuickBooks set up correctly, you need to be able to push cost into the right bucket. So you might end up needing to set up like a couple allocation spreadsheets outside of QuickBooks that would inform where you want to move things within the system. So at the end of the day, you can get good outputs. And that might even require setting up time tracking as well. So just keep all of that in mind with grants. if you get one and you're not doing any structural changes, it's probably going to be really difficult on the back end. Or if you do it yourself or you don't ask or you guess, I mean, a lot of times when we come into clients, the classes and the chart of accounts get really convoluted, and there can be duplication. Like you might end up seeing duplicate R&D accounts going down vertically, one for each grant, when instead you could have accomplished it this way with this additional dimension. And then lastly, this is the expense reporting piece. We highly recommend using a tool that your credit card hooks into. So if you're using Amex, you could link it with Concur. Divvy, Brex, and Ramp are all credit cards themselves with really powerful expense reporting on the back end. But basically, it'll make it anytime you spend money, you just go into the app, code it to an expense account, code it to the right grant, take a picture of the receipt, and it's done. If you're not doing that, it's really hard to, your accountant's going to be asking you for every transaction where it needs to go. And you might have a shoebox full of receipts that you got to take pictures of later, or you might not have any support. So we certainly recommend leveraging technology to make this easier. And this is especially true if you have a team with credit cards and more than one of you is spending money, you absolutely want to have one of these in place. So I will pause there and open it up to any questions on grants. And I think I see one in here. We'll be receiving some grant money. Should we set up a separate QuickBooks platform for grant income and expenses? No, I don't think you need a separate QuickBooks, but you should modify your existing QuickBooks into something like this so you can track it appropriately. Any other questions here?
There's a question in the chat. Oh, sorry, go ahead.
Nope, that's what I was going to say. Go ahead, Catherine.
There's a question in the chat from Michael who said, into what account should a safe note be entered?
Yeah, so that's a little bit different than a grant. A safe note would be more like a convertible equity, or it'd be more like convertible debt. The simple answer is that most times a safe is going to be in equity, so that would be on your balance sheet. I would create an account that says safes and code it to equity. The full answer is there's 50 pages of accounting guidance on how to look at a safe and where to park it. So it could be debt, but we tend to see that pretty rarely. So good rule of thumb is park it in equity, and you should be in pretty good shape. That's going to make sense to everyone. And if you have an audit requirement down the road, you can kick the tires on it then and make sure it's in the right spot. But investors are going to like seeing an equity, and that's going to make sense for you too when you look at your business, because you're not necessarily going to pay that back in cash. Great question. All right. Next up, inventory accounting. I included this because I know, clean tech tends to be, you guys are very physical businesses. It's not like SaaS. So being physical businesses, you're going to have inventory. You might be doing some manufacturing. So inventory is a really big deal for you guys. Common reasons there's issues with inventory are this delineation of like when you first start having inventory. So before you start selling to customers, as you're just trying to figure out your product and you're tinkering with things, that's all research and development. And that's super easy. You don't have to track anything from an accounting perspective, at least. Just let's expense it, let's put it to research and development accounts, and we're done with it. But when you start selling and you cross that threshold, now you're holding these assets in inventory, and they're leaving later, and there's a whole timing consideration that needs to be thought of. And we also need to track this stuff to safeguard our assets and have a good sense for where all this valuable stuff in our business is. So that's kind of the switch. When you start selling, you need to start tracking inventory, and it looks very different than when you were just doing research and development. So blowing by that benchmark is a common reason that inventory is off. Lack of expertise. Inventory accounting is really hard to do right. Even for experienced accountants, it's hard to do, and it's really hard at this scale because good inventory tools can be really expensive. So a lot of times for startups, you're trying to do something inherently complex without the right tools, which adds even more complication to it. And then also very common for if you do have a tool, it's very common for it not to be set up correctly, or maybe it's set up correctly, but your team's not using it right. Everyone in the business, the person who orders parts and pieces, the person who receives raw materials, the person who puts it together, the person who sends it out the door, the person who pays the bills, like all of those people need to be aligned with how to use the system, or it inevitably falls apart. And when it falls apart, it looks like this warehouse photo here. Like this picture is a really good example of what an accounting system looks like if inventory has not been done correctly. It's also probably a really good example of, how accurate your books are. Like if it's not hitting the system right and your books are like this picture, they're only going to be so useful to help you make purchasing decisions, manage your cash flow. And at the end of the day, eventually you're going to have to get it right. And this is a really expensive mess to clean up. So ultimately, what we want for all of you guys is we want it to look like this from day one. So how can you create inventory workflow in your business so you're neat and organized? The first thing I always recommend to our physical business clients is see if you can use 3PL, it's a third-party logistics provider, to warehouse your inventory, or potentially a contract manufacturer to make your product. I know that's not always possible, especially in this space, but it's always a good place to start. And even if it's a little bit more expensive, if you're using one of these solutions, you don't have to build a whole inventory tracking system in-house. You don't have to teach your team how to maintain it. The accounting is a whole lot easier. Operationally, it's probably easier too. It puts the burden of all of that on someone else. So again, not always possible, but always consider it. Loop in your accountant when you have inventory. Definitely don't go at this one alone. For sure, make sure you have the right person. And I'd say a good time to do that is 6 months before. Like at the end of the day, you could call me today and say, "Hey, Matt, we had our first sale this month and we'd figure it out." But if you called me in September and said, "We're going to have our first sale in January, I know there's some things that need to be done. Can we start working on it?" We'd be a lot better positioned. And then lastly, the whole team needs to be aligned on it. So whatever you choose for inventory, whether we're doing it in QuickBooks, Excel, an add-on to QuickBooks, an enterprise accounting platform like NetSuite, in all of those instances, multiple people need to be aligned on the process. So if we go back to that standardization, if you're going to document one thing in your business and you're an inventory business, let's focus in on getting the inventory process dialed. And then this is the last one, common reasons for mistakes. Maybe you don't have advisors, you have the wrong advisors, or you're not including your advisors in helping you run your business. So as a baseline, I think everyone in this room should have a really good lawyer, and that's a good place to start. And you might need 2 lawyers, definitely a good commercial lawyer. And then for you guys, a lawyer who specializes in IP is going to be really important. Also, you probably want 2 accountants, and we kind of touched on this before. Have a tax expert. that's really relevant as well with the Section 174 stuff and, R&D costs for you guys so you don't hit taxable income. So have a strong tax advisor and then have someone like us who really knows what they're doing when it comes to the books and operational accounting and, all the stuff we hit on today. I hope you guys can see like it's a lot different from tax, and maybe this connected some dots like why you might need more than one accountant. And then lastly, have a really good board. Our most successful clients have really strong boards, and they communicate well with them. So, when I put all this together, you don't know what you don't know. So if you have these three resources around the table, just pick up the phone and ask questions. Anytime you're doing something big, call whoever you think might need to know about it and fill them in. And you never know what might come back. I know accounting and legal, like those things can be expensive, but we've seen a lot of messes over the years, and I can guarantee you it's always more expensive to clean up something that was, DIY or just not done right up front than it is to just spend the money up front and do it tight and do it right the first time. And then when it comes to your board, be realistic, open, and honest. Our clients who communicate bad news clearly and just tell it like it is get the best outcomes from their board, and their board really appreciates it. I think there's a lot of respect from those experienced advisors who don't feel like the CEO is trying to bullshit them. We've seen some clients over the years kind of try and dance around really big issues, only talk about the positives and ignore the negatives. And if you're doing that, it's not really in anyone's benefit, and it's going to come back around. So definitely just be open and honest. So what did we learn today? Now's a great time to get your accounting in order. Prioritize having good books in your business. Hopefully from all the stuff we went through today, you can see how this creates a lot of unlocks. Track your cash closely, standardize where you can. If you have grants, think about structurally how you want to set up your QuickBooks and maybe allocations, expense reporting around it to be compliant. Be ahead of inventory, not behind, and collaborate proactively with your advisors. I think if you guys apply these things in your new year, you're going to be really successful with your accounting. And I hope after today you can see how that would kind of bleed into other areas of your business working really well and supporting you all to make good decisions along the way. So yeah, I hope this was helpful. And I think we're basically at time because we did questions throughout, but I've got a couple minutes. We've got a couple minutes left. If there's any kind of final questions we want to throw in.
Sid in the chat asked for recommendations for tax advisors.
Yes, I've got lots. Sid, I can send you an email directly with some recommendations. And I guess if other people want tax advisor recs too, maybe just put it in the chat and I'll reach out to you and give you some names. I've got a reasonably long list, and different advisors are better for different people and businesses at different stages. But I'm happy to make intros.
Great, thank you.
Yeah, of course.
Any final thoughts or questions from our audience? If not, nope. If not, we will close out. Thank you all for joining. Thank you especially to Matt. I learned a lot. I'll be calling you. Really appreciate you taking the time to walk us through this. And this was a lot of really good information. So thank you.
Yeah, you're welcome. Thanks, guys.
Thank you, Matt.
Take care.